Good morning, and welcome to the Cemex Q4 2020 conference call and webcast. My name is Chuck, and I'll be your operator for today. At this time, all participants are in a listen-only mode. Later, we will conduct a question-and-answer session. If at any time you require operator assistance, please press star followed by 0, and we'll be happy to assist you. Our hosts for today's call are Fernando Gonzalez, Chief Executive Officer, and Maher Al-Haffar, Chief Financial Officer. And now I'll turn the conference over to your host, Fernando Gonzalez. Please proceed.
Good morning, and thank you for joining us today on our Q4 2020 conference call and webcast. I hope this call finds you and your families in good health. I'm joined today by Maher Al-Haffar, our CFO. Before we start, I would like to take a moment to express my gratitude to our employees who have risen to the challenge of COVID and adjusted their work habits to act safely and effectively, and to still deliver results. However, despite our best efforts to keep employees safe, we have lost treasured colleagues during this pandemic. I would like to recognize these individuals and their important contribution to the company, and to extend my sympathies once again to their families and friends. And now, we will spend a few minutes reviewing the business, and then we will be happy to take your questions. 2020 was one of the most challenging years we have faced, but it also was a remarkable year that tested the strengths of Cemex and several of our recent strategic initiatives. I'm proud of our performance, the organization, and how we responded to the sudden arrival of coronavirus in our footprint. We reacted quickly and forcefully to a highly uncertain situation. We prioritized the safety of our employees and customers while ensuring business continuity, financial flexibility, and protecting the future of Cemex. The investments that we have made in distribution and digital platforms paid off in the pandemic, while our emerging market footprint shone through as a competitive advantage. And as visibility improved, we were agile and adjusted quickly to take advantage of developing opportunities in our markets. Our customers rewarded our safety, reliability, and consistency efforts with the highest Net Promoter Score in our history. Importantly, our score is now in line with the NPS of some of the world's most recognized consumer brand companies. Despite the enormous disruption of COVID-19 throughout our operations, we were able to close the year with a 7% expansion in EBITDA on a 1% rise in sales. EBITDA growth was largely driven by pricing and operation resilience. We posted the lowest OPEX as a percentage of sales in our history in 2020. The first 2 months of 2020 went according to plan, with year-over-year growth in all our geographies. In February, however, COVID-19 cases began to escalate, first in Europe, South Central America and the Caribbean, and the Philippines. Governments devised their own individual playbook to combat the virus and impose lockdowns of many different shapes and sizes. The severity of those lockdowns very much determined industry performance. The US and parts of Central Europe were relatively unaffected. In Mexico, under the lockdown measures, the industry was limited to bag cement for the retail market and essential infrastructure, a regulation that significantly impacted formal construction demand. And in other regions, such as the UK, Spain, and France, while the industry was open, strict social restrictions impacted demand. And finally, in a number of SAC countries, as well as the Philippines, the construction industry was shut down for weeks or even months. As restrictions came off in various markets, we experienced a V-shaped recovery in cement demand, and in our two most important markets, year-over-year growth. But the same was not true for ready-mix, aggregates, and bulk cement in Mexico and SAC. In these geographies, these products have a much higher exposure to formal construction than bag cement. Using ready-mix as a proxy, you can see that the recovery has been much slower than cement in reaching pre-pandemic levels. We believe that this behavior can be explained by government restrictions, economic uncertainty, and the pivot of governments to focus their limited resources on the pandemic. This formal sector recovery process will be an important driver of both ready-mix and aggregate demand in 2021 as GDP growth returns to this market. As you know, we announced Operation Resilience in September to address changes in outlook arising from COVID-19. Despite a volatile year, I'm happy to report that we have made progress against our medium-term goals. We finished the year with a 19% EBITDA margin, an increase of 90 basis points, and roughly halfway to our 2023 target. With regard to our capital allocation plan, the pandemic has somewhat delayed execution against these goals. Last week, we announced our first asset sale for close to $50 million, and we are confident there will be more to come. We did make important strides in our number one priority of debt reduction in 2020. Our net leverage ratio declined 1/10 of a turn for the year and is down 1/2 a turn since the peak in second quarter. Our COVID-19 cost freeze significantly restricted CapEx in 2020, thereby postponing much of the planned strategic investment. Our new business of urbanization solutions, however, has continued to grow as a result of prior year investment. For full year 2020, EBITDA from our urbanization solutions grew 15% year-on-year and accounted for 6% of total EBITDA. Due to COVID-19, our net CO2 emissions are stable versus the prior year. This is an important metric for us, and I will go into more detail on the next slide. 2020 has been a busy year for us in the sustainability front. In February, we rolled out our sustainability goals for 2030 and 2050. The goals are aggressive, with a commitment to reduce carbon by 35% by 2030 and an ambition to deliver net zero concrete globally by 2050. We have a lot of confidence in our ability to achieve these goals, particularly the 2030 goal, where we rely only on technologies known to us and that we have used previously. Our confidence is also rooted in our experience in Europe, where the region has already secured the 35% reduction target and has committed to a 55% reduction by 2030. The European business will lead the way for us in our sustainable transformation. With clearly established goals, we need to execute against them. We have a detailed roadmap on a plan-by-plan basis that has been validated by Carbon Trust, an internationally recognized consulting company that provides a rigorous third-party assessment of carbon reduction plans. In 2020, carbon emissions were flat versus the prior year due to a shortage of alternative fuels in certain key markets caused by COVID-19 supply chain disruptions. In 2020, alternative fuels constituted 25% of total fuels, an approximately 3 percentage points decline from 2019. Despite the decline in alternative fuel usage, I'm happy to report that there were some important advancements for us in 2020 that will pay off in 2021. We reduced clinker factor by 1.1 percentage points, the largest decline in 5 years. We retrofitted all our plants in Europe to utilize hydrogen injection. This will allow us to achieve a higher alternative fuel substitution as well as reduce heat consumption in a significant way. We are now extending hydrogen injection to the rest of our operations. And finally, the 2020 deferred CapEx will be executed in 2021 and will provide an important lever to make up for the ground that we lost on carbon due to COVID. I'm very confident in our ability to reduce carbon materially in 2021. Despite the continued challenges of the pandemic, fourth quarter was a banner quarter. We reported the highest fourth quarter sales since 2014 and the highest fourth quarter EBITDA since 2016. Importantly, momentum is accelerating in most markets, suggesting that most countries are positioned at a favorable point of the cycle. Mexico bag cement maintains growth cadence while we saw continued recovery in the formal sector, leading to the largest quarterly volume increase since at least 2007. In the U.S., we achieved the highest reported full-year EBITDA since 2007 and the highest cement volumes since 2016. This is without adjusting for asset divestment. Gains in working capital led to strong free cash flow generation, which we directed towards debt repayment. Finally, we achieved the fourth consecutive record quarterly NPS score with year-over-year improvements in all regions. The 9% growth in sales with EBITDA growing at twice the sales rate speaks to the momentum of the operations. Importantly, each of our four regions contributed to EBITDA growth. Our Operation Resilience cost savings initiatives were an important factor in our margin performance and were largely responsible for the 1.2 percentage points improvement. Against what was already a very difficult comp, we were able to outperform the prior year free cash flow execution. Looking at full year 2020, we achieved the highest free cash flow after maintenance CapEx since 2017. Volume growth driven by the U.S. and Mexico was the biggest contributor to EBITDA growth. Operation Resilience cost savings, volumes, and a decline in fuel costs added to margins. Fixed costs rose due primarily to higher maintenance in fourth quarter as we executed deferred projects from earlier in the year. Importantly, we registered the smallest FX headwind in 5 quarters as the super dollar trend appears to be unwinding. As I mentioned, Operation Resilience was an important contributor to margin improvement. We achieved our targeted amount of $280 million for the year, equivalent to 2.2 percentage points of EBITDA margin. SG&A accounted for the majority of savings, with reduction in fees, sales, travel, and headcount expense. All regions had significant cost reductions. We expect 70% of these savings to be recurring. For 2021, we will maintain the same cost restrictions and offset the non-recurring 2020 costs with savings from initiatives already implemented in the prior year. Our U.S. operations continue to enjoy strong momentum in the fourth quarter, driven primarily by the residential sector and mild weather throughout our footprint. Cement volumes rose 15%, with most key states enjoying double-digit growth. Our aggregates and ready-mix volumes increased by 7% and 6% respectively. The significant volume growth speaks to our geographic footprint in the U.S. The unusual dynamics in California, where customers have been on allocation for much of 2020, a change in the reporting treatment of imports, as well as on-market share gain. After several years of consistent market share loss in a number of markets in the U.S., In 2020, we recovered part of that loss. We believe our current market share is sustainable, and our focus will remain, as always, on value before volume. For the full year, cement volume